Hello, everyone. Good morning, good afternoon, depending on where you're joining us from. My name is Courtney, and I am so glad to welcome you to today's presentation, which is a Q2 outlook on 2024 tax changes. Today, I'm excited to be joined by tax experts both at PwC and Avalara, who are going to be spotlighting some of the tax trends that they're seeing, as well as pending legislation that could impact your compliance obligations for the rest of 2024 and beyond. Before we dive into the meat of the presentation, just wanted to review a couple of housekeeping reminders. So as usual, we are recording today's presentation. So if you'd like to listen to it again or even share the recording with a colleague, keep an eye on your email inboxes. We will send out a link in about 24 hours with the recording, which will send you right back to this console. Next, let's look at this console and how you can interact with us today. So there's a Q&A box over on the left-hand side of your screen, directly underneath the video feed. You can use that box to submit questions for myself or our speakers. We will be responding to questions individually as we're able to through that box. And then we do have some time set aside at the end of the presentation for Q&A with our speakers as well. So be sure to stay tuned for that. There is also a community chat on the console that you can use to interact with your fellow webinar attendees. So feel free to introduce yourself there and network with other tax professionals that are joining the webinar today. And then we do have related resources and links available on the console if you're interested in learning more about the topics that we're discussing today. All of those will open up in a new tab and will be waiting for you when the webinar is over, so you don't miss any of the good stuff we're covering today. And that's also where you can download your own copy of today's presentation slides if you'd like to save those for later or just use them to get a sneak peek of some of the topics we're covering today. Just a quick note that these slides actually do contain several links in them as well. We're talking about a lot of pending legislation, so we have links to some of these specific bills so that you can actually read them. So I just wanted to call that out. If you are interested in seeing some of those bills or other related resources, be sure to download the slides and you'll have access to those links there as well. And finally, new to the console, we've added the ability for you to add reactions. So if you'd like to let us know how you are feeling or what you're thinking about any of the topics we're covering today, you'll see a little smiley face down at the bottom of your console, and you can click on that and see available reactions. And on the presenter side, we'll see them float across our screen, which is always fun. Just a quick disclaimer, Avalara is not a legal tax advisor, so everything that we discuss today is for educational purposes only. But as always, we do our best to respond to questions as best and as thoroughly as we can. And finally, we are offering 1 hour of CPE credit for today's presentation. For those looking to receive CPE, please note that you will need to respond to 3 out of 4 poll questions that will appear on the console. They will pop up randomly over the course of the next hour and will only appear on the screen for a limited amount of time. So make sure that you're ready to answer those when the questions appear. And in order to qualify for CPE, you'll also need to attend today's session for at least 50 minutes. That's 50 minutes. Once you've met both of those requirements, you'll be able to download your individual certificate in the Earn Certification box that's appearing on the console. You can click on the access to download your PDF. And then we'll also include a link in the post-event email to your certificate if you need that as well. All right, so let's take a quick minute and meet our presenters today. So as I mentioned, I'm happy today to be joined by a couple of individuals at PwC and Avalara. So first up, we have Vanessa Frank, who is the Director of U.S. Indirect Tax at PwC. Vanessa, it's great to have you. Do you want to take a minute and introduce yourself?
Hi, my name is Vanessa Frank. I am a director in San Francisco, one of many directors and partners in our U.S. indirect tax practice. I have been with PwC a little over a year. I have over 20 years experience in indirect tax and most recently spent 10 years in various roles at companies in the Bay Area, including most recently 3 years setting up a very large marketplace facilitator in Silicon Valley with their requirements. It's great to be here. Thank you, Courtney.
Awesome. Thank you, Vanessa. Next up, we have Dorothy Lowe, who is also with PwC. She is a principal of indirect tax. Dorothy, I'll pass it over to you to say a quick hello. Thanks for being here.
Thanks, Courtney. Hi, everyone. I'm Dorothy. I've been with PwC for about 18 years now, currently focused on indirect taxes, support, from startup to big tech and all manners of clients in between. So happy to be here today to talk to you about Q2 developments.
Fantastic. Thanks, Dorothy. And last but not least, we are joined by Brian Smith, who is one of my fellow Avalarians. You'll see the resemblance in orange. But he is our Senior Government Relations Manager. So, Brian, great to have you.
Thank you. Great to be here, Courtney. I am, as Courtney said, government relations. So I spend a lot of time in government meetings, listening to where they think tax policy should go. And hopefully this presentation will show you some of that. My background was with a startup in California, which you two ladies at PwC are probably very familiar with. It was an incubation project that turned into DirecTV. So I was lucky enough to spend 33 years running their indirect tax practice.
Awesome. Well, thank you all three for being here. Really appreciate it. And looking forward to diving into our presentation today. So quick high-level look at the agenda and what we're going to be speaking about. We're going to kick off today's webinar talking about some trends in digital goods and services taxation. There have been some recent developments there. We'll go over how some states are simplifying their economic nexus thresholds. We'll dive into marketplace definition updates and what that means for marketplace facilitators and marketplace sellers. We'll take a quick look at some updates on retail delivery fees. We'll also look at the taxability of services and some recent activity within the states there. And then, like I mentioned, we do have some time dedicated for Q&A at the end of the presentation. So with that, I am going to turn it over to our speakers at PwC to kick us off with the taxation of digital goods and services.
Yeah, sounds good, Courtney. And I'll start with Virginia. So Virginia is definitely, the big buzz right now. The budget kind of proposed expanding the tax base to digital goods and services. And, they included a proposal to expand, the digital, the sales and use tax base to digital personal property and taxable services, which is a huge change, right? It includes streaming and software application services. And if enacted, this legislation would be effective January 1st of 2025. And so the budget legislation proposes to expand the definition of taxable tangible personal property to include digital personal property, right? And that's defined as digital products delivered electronically, including software, digital audio, audiovisual products, reading materials, and other data or applications that the purchaser owns and has the ability to access, right? Whether by downloading or streaming or otherwise accessing the content without having to pay an additional subscription or usage fee to the seller after paying the initial purchase price. Again, that's a huge change for Virginia. The legislation also provides that taxable services means that the following services used or consumed in Virginia, such as software application services, computer-related services, website hosting and design, data storage, and streaming services, right? And streaming means a method of transmitting or receiving video or audio data over a computer network as a steady, continuous flow, allowing playback to proceed while subsequent data is being received, right? The important thing here that folks have been kind of focusing on is that there is a business-to-business exemption that would be provided for computer-related services and website hosting and design, data storage, and streaming services. But this exemption explicitly would not apply to software application services, which are not currently defined. And so that's something that, folks are trying to ask for clarification on, because software application services can be very broadly defined. And so we're kind of looking to see, if the legislature makes some changes to that or defines it further. Vanessa, do you want to talk about West Virginia?
Thanks, Dorothy. I think what we're seeing is in an election year, many jurisdictions writing proposals on taxes that may be implemented in the future. An interesting development out of West Virginia, and as a reminder, West Virginia is a member of the Streamlined Sales Tax pact. It's a full member state. And during the pandemic in September of 2021, West Virginia clarified through a taxpayer services publication the taxation of streaming services subject to sales and use taxes. West Virginia has maintained this is not covering sales of digital products. However, Streamlined Sales Tax held a meeting recently, and they were looking at whether or not this was in compliance with the uniformity edicts of Streamlined. So I think this is an important development just to keep tabs on, right? Whether we will see more states within Streamlined looking at expanding their tax base in a similar way to West Virginia, whether or not West Virginia has successfully carved out a tiny piece of taxation on streaming services. So just a high-level reminder of that, something to keep tabs on. I'm going to move to the next topic. So I think in line with what Dorothy mentioned about Virginia, we are seeing a number of jurisdictions revisit the taxation of new revenue streams. And probably the most notable is the taxation of collection of consumer data. I'm going to start with Illinois because it is where I was born, and it is a state near and dear to me. Senate Bill 2307 has been levied at a graduated rate, so 5 cents per consumer on less than 1 million Illinois residents, to a rate of 50 cents per consumer plus a $2.25 million a month tax collection if data is being collected on 10 million or more residents in Illinois. This was particularly interesting to me because Illinois only has about 13 million residents. So I think that this is a creation of a new monthly excise tax on the collection of consumer data by commercial data collectors. What is also notable about this specific proposal is that it is broad-based. It doesn't go after one of the large tech companies based on the West Coast. It would apply to all data collectors. It's not just limited to social media companies. It would include insurance companies, retailers. Think about the data that may be collected on you by the use of your club card or by a device in your car, right? The Council of State Taxation has come out in opposition of this tax, indicating that these activities are already taxed under the income tax regime. I think that this is an interesting proposal because it is a new line of taxes and it is a flavor similar to a data services tax. New York has issued a similar proposal in both Senate Bill 2012 and Assembly Bill 3959 that have this similar graduated rate of 5 cents per consumer below certain thresholds. Massachusetts Senate Bill 1892 has a similar type of imposition, but this particular bill is looking at taxing the mental health impacts of social media. So I think that this is a trend that we're going to see continue in many jurisdictions, especially those jurisdictions that potentially are facing budget deficits, where they are not necessarily expanding the tax base or increasing the tax rate, but they are levying or proposing to levy new tax types on broad bases of companies. And as with anything else, I think when you segregate and you propose a tax just on a minority of companies that seem to be making astronomical profits, there are unintended consequences that come along with that. Especially in Illinois, I can see that this broad-based proposal could potentially impact many companies that are potentially not intended as the audience for this additional tax. I'm going to move on to Streamlined is looking at digital taxes. I think, one of the challenges is the creation of Streamlined was in 2005. We've come a long way. And so they're looking at 2 weeks ago, the governing board met in Oklahoma City and they debated tax collection on digital codes that represent software, in-app purchases, and non-fungible tokens, NFTs, at the time the code is sold. They are looking at proposed amendments to the streamlined sales and use tax agreement. I think that this again is something to keep an eye on, right? I think that there is an acknowledgement, I think, amongst many jurisdictions that the sales tax code is outdated, that it's not keeping up to date with the current purchasing habits of the average US consumer. And I think that this conversation in Oklahoma City a couple of weeks ago by the Streamlined Sales Tax Governing Board indicates that there is a renewed interest by many jurisdictions to look at taxation of digital codes.
And just along those lines, in that meeting, there seems to be a conflict that we're trying to streamline things and get as much money into the states as possible. I mean, that's the goal of Streamline. To do that, Streamline's been focusing on, well, let's make sure it gets to the right location. Let's make sure they have the right rate. And we're faced with a changing economy in that everything's happening online and people aren't typing in their full address. They just hit a link and hit Apple Pay and it shows up the next day. So we've got to figure out how to bring those two kind of elephants in the room together to reach an agreement. The states want their money. The states want to make sure they get it accurately. Companies don't want to collect more personal data than they have to. So these are, I think, struggles we've seen for the past 3 years. We'll probably see them for the next 3 years. But those are things that are being contemplated because they're selling services, they're not shipping you a product. So yeah, that's kind of a difficult one to tackle.
I think that's very helpful, Brian. Thank you for those insights as someone in the room or streaming and watching the room.
Well, I was there.
You were there, someone in the room. Well, speaking of, I was there, digital advertising taxes. I was fortunate enough to sit in the room 2 weeks ago in Sacramento when California held an informal hearing on a potential digital services tax type. And there was an informal hearing held where we heard from notable speakers in this space. I think that there is an acknowledgement by at least a dozen states that there is the opportunity for a wholly new tax targeted specifically at digital platforms. During the pandemic, we saw the introduction of digital services taxes in Europe. And I think that this is a topic that many US states have been discussing ever since. The digital services taxes in Europe is a tax on consumption from the barter side of platforms that is not currently taxed. That's the position of all of the individuals who write these digital services tax laws. And one of the most prominent speakers is Darian Shansky, who is a professor of law at UC Davis, and he is in support of a digital ads tax. And his position is that there is an untaxed consumption, an opportunity to tax untaxed consumption using ad revenues as proxy. And so really he believes that when individuals utilize social media, they are utilizing it for free, but they are paying in the form of their own user data. And that data is highly desirable to many companies. Now, the interesting thing about the informal hearing is that there were companies other than social media companies who were analyzed, who are collecting data, notably some large online retailers and marketplace facilitators. And I think that the overwhelming consensus is that this is an area that state legislatures are going to look at to potentially tax in the future. However, they are also aware that the Maryland digital advertising tax was very problematic. And the strongest argument against the Maryland digital advertising tax is that it is preempted by the Internet Tax Freedom Act. There are other issues with the Maryland digital ad tax, and there were some excellent commentary provided about how problematic that tax is. So I think what is interesting is that, Darian Shansky, after he spoke, he mentioned to a number of individuals that he would be going to Tennessee. So he's obviously been a resource for a number of jurisdictions who are looking at writing a more robust law to tax digital advertising receipts. Tennessee's pending legislation actually just failed in subcommittee. And I think that what we will see is different flavors, I think, of this type of a tax being introduced. It's an important thing for everyone to keep in mind. You may think, I don't work for a company that has digital advertising revenue, but I think what we're seeing, for example, in New Mexico, is that their gross receipts tax rules are looking at items such as search engine banners and ads on online marketplaces or online retailer sites. And I think as consumers, we may not always be aware of the fact that we are being targeted by ads. It is becoming more obvious in this day and age, but I do think that we will see states aggressively going after taxes in this space in the future.
Yeah, I agree with that, Vanessa. Like, one thing that the states have paid attention to is that for Maryland, in that single year they had this tax, they raised about $100 million. And that $100 million is only paid by about 70, right? And so states are definitely looking at these taxes, or these type of taxes and variations of it, to kind of make sure that they raise revenue and, cut that budget gap wherever they have it. So it's a good point, Vanessa.
And Dorothy, I think you cut out, did you say 7 or 70?
70.
Yeah, 70. Okay. I think we can probably name 7, but I don't know that I could name 70.
I have a quick question before we move on to the next section. But since we have someone who is focused on government so much, why do we think that states are really eyeing these new revenue streams, looking specifically at digital advertising and digital goods and software? Brian, is that something that you can speak to a little bit?
Sure. I think, some studies have been done post-pandemic that show all the additional revenue states were getting during the pandemic, predominantly driven by people spending money because they were home and generating all those tax dollars. We're seeing that tail kind of get pretty narrow. And so now they're realizing that they're going to be facing budget deficits. So I think one thing that's happening is they're obviously going to expand their tax base, and including a specific product or line of products is a way to generate a lot of revenue, especially since this is the fastest growing segment of the economy. They say that 70% of items consumed by purchasers are services, and they're not things. And the states that are not facing a budget deficit are states, South Dakota, Hawaii, who else do we have? New Mexico, Texas. They all tax services or have a gross receipts tax, which has gotten them a lot of grief in the past, but serves them well now. So I think what we're seeing is states don't want to come out and say, I'm going to tax all services starting Tuesday. They're trying to go after the low-hanging fruit. It's just not an easy grab like they thought it was. And so they're going to have to wrestle with industry, figure out how to correctly position this. Is it business to consumer, business to business? What if it's a manufacturing input? It's extreme. It gets really complex, as all tax things do. And so we're going to make that transition, and it might take 5 to 7 years. It's going to be an interesting process.
Definitely. Thank you. Thank you for sharing that. I think that's an interesting approach to it. But I'm going to let you hold on to the mic and talk us through some of the updates that we're seeing on Economic Nexus.
Sure. Let's see, we just passed the 5-year anniversary of Wayfair earlier this year. The measure for Wayfair, and if you had to remit taxes as a remote seller, initially followed the court case, which had a dollar value and a transaction number. Typically, it was $200,000 of sales, which isn't as simple as it sounds. And some states had 500,000 and 200 transactions. And what became apparent, I guess over 5 years, is that the 200 transactions can be deceiving. Because if I sell one airplane at $65 million and I'm sitting, 3 states away, you probably want the tax on that, even though I'm not registered. And so states have, especially streamlined states, have pushed across the organization, which is 22 states, to remove the $200 threshold. And what we're seeing here are 3 states that all were going full speed. Indiana got it done. Wyoming got it done. Utah was a little late to cross the finish line. They ran into some issues with budgetary constraints, which I don't completely have my head around yet, but they still have to remove their limit. So I think eventually the numbers are going to get smaller and smaller, and pretty much all remote sellers of any size will be required to collect and remit. And if we go to the next slide, here's an example of the patchwork. The big states, California, Texas, New York, all have very high thresholds. There are still a few states that have the 200 transactions, and I think those will start to unwind over the next 2 years. So you can see New York's at 100 transactions. What gets confusing is, how do you measure 500,000? What's included? Are your retail sales, or your wholesale sales, or your B2B sales, or just your retail transactions to customers? So it can get simpler, and I think it will, but this gives you an idea of where we sit today.
Let's dive into marketplaces. So I think that this is something that we've seen, as with Economic Nexus, is starting to broaden out, but it sounds like there have been some clarification around what the definition of a marketplace is, and several conversations about what that means.
Yeah, this is, it seemed pretty straightforward that if, you were going through a marketplace facilitator, we all know who we buy through online, big companies, that the marketplace facilitator could be responsible for collecting and remitting tax. People are peeling this onion and realizing it's a little more complex. I know, kind of strange. Indirect tax, complex, different every state. It's taken some national organizations kind of putting their heads together and trying to simplify this in a reasonable way, not just making it read on paper correctly, but getting buy-in from departments of revenue, listening to industry input, and they're getting a little pushback. As you can imagine, if I'm a marketplace facilitator because I sell a lot of postcards out of my garage, you know, I don't necessarily want to be collecting tax for every postcard I send out, you know, that isn't mine. I'm just holding the inventory and selling it for someone who's liable. What if you didn't use the right rate? And that's an interesting point in that since Wayfair, many states have put a big push behind transparency to taxpayers. You know, one of the big things we hear is there's not enough ease of use of information. So some of the more progressive states have done a great job at increasing the information available to taxpayers on their websites. And you start seeing marketplace facilitator portals just designed to make sure that those people outside the state who aren't used to doing business in the state have the ability to quickly ascertain, where do I situs the transaction? What's the correct rate? You know, it seems simple, but if you were shipping into Calcasieu Parish, you might not necessarily know the right local tax rate to collect or even where to remit it. And so states are aware of this, and states that have put in these portals or increase their transparency, they're putting hold harmless provisions. If you use their data and their rates, you're held harmless should it be discovered that the rate you used was incorrect. So states are working and they're seeing the benefit because they're seeing more revenue. Complexities. I don't know, Vanessa, any complexities with that?
I tell so many stories, but I wouldn't want to talk anyone's ear off. I think the challenge and the assumption by many jurisdictions is that they would pass Wayfair type laws and marketplace facilitator laws, and companies would miraculously be able to comply. And I think the other challenge is during this time period, we were in COVID, right? So not only had these laws been passed, but the entire buying audience had shifted to online. And so we saw record amount of revenues. We saw brick and mortar stores shift to move their inventory into an online selling format or to sell through a marketplace facilitator. And I think, the conversation 5 years later is surrounded around audits and all of the unintended consequences, right? And I don't think the states will primarily be going after the marketplace sellers. They will be going after the marketplace facilitators because they know who has the deeper pockets and who has the records and information available. But, not all marketplace facilitators are created equal. Some were retailers before they were marketplace facilitators, and they had the ability to pretty seamlessly, or in some instances seamlessly, turn on the collection of tax for their marketplace sellers. We're seeing some interesting litigation come out of South Carolina as an aggressive jurisdiction about whether or not certain retailers may be responsible for sales taxes ahead of marketplace facilitation laws. And so I think that we are going to see the states doubling down and being more aggressive, especially in the face of economic deficits. I think that we are also seeing clarification quietly by a lot of states about their marketplace facilitator laws. So, for example, in the next slide, I'm going to chat briefly about California. 1684.5 really was the CDTFA's clarification on California's marketplace facilitator law. And California all along felt that they had introduced one of the most broad pieces of legislation on marketplace facilitation, but there were still questions about whether a company was a marketplace facilitator. I think that just because you call something a marketplace doesn't necessarily mean that there's marketplace facilitation going on. But I think that there's been a lot of companies who stuck their heels in the sand and said, I'm not a marketplace facilitator. I'm not collecting this sales tax, whether they could or not. And California came back and said, listen, we had some emergency regulations in place. They were repealed as of June 29th, 2022. These emergency regulations are replaced retroactively back to June 30th of 22. 1684.5 is the law of the land as it relates to marketplace facilitation. And I think really there, in my conversations with colleagues, with individuals who are much smarter than I am, really what I understand this to mean is that California just felt that this is what they intended all along, but they cemented it with this regulation. And so I think if you are a company doing business in California and you are concerned that some flavors of your activities may be marketplace facilitation, I encourage you to take a look at this pretty closely. So I'll pause there. Brian, do you have anything else you want to layer into that?
You should have your attorney read it too.
Well, yeah. Yes, have your attorney.
No, I mean, it's what you, on the surface, as you said, looks pretty straightforward. And then they put in clauses that say, if you provide any payment processing activity, as the slide shows, or fulfillment services, I don't know how you, if you have product, well, my personal opinion is if you have product in your warehouse and, you set it outside the back door and somebody picks it up, you're participating. I mean, I'd rather have it broad and inclusive than segmented and, 18-step tests to see if you're supposed to collect. It's a little complicated.
Yeah, I think California, in the public commentary related to this regulation, basically said, we don't want to see companies try to avoid their sales tax collection obligation by removing a piece of the pie, right? By saying, oh, well, I'm not processing the payment, so I have no way of collecting the sales tax, right? But I think to your point, Brian, if you are engaging in certain activities related to customer service, if you're delivering the goods, if you're insuring the goods, if you know where the goods are going within California, you may have an obligation. And so I think what this does is it ensures a level playing field in California relative to marketplace facilitation.
Well, it would be interesting who carries the risk of loss in that situation. That we've been looking at that for 30 years. Well, when I send all my product to a cage in somebody's huge warehouse, do I have to insure it? Am I covered by their insurance policy? I mean, yeah. I mean, it's complicated.
Yeah, it's complicated. And I think it's important. I think, Brian, you made an earlier point in one of our pre-planning discussions about the fact that it's provided a template for other jurisdictions to expand and broaden their own marketplace facilitation laws. So I think the other, call out that I would make here, my orange warning flag, as it was, is, if you looked at marketplace facilitation laws back in 2019 and 2020, or even 2021, I think that the jurisdictions have quietly passed amendments to those laws and required the collection of special fees in addition to sales taxes. And so I think that is a trend that will continue, that we're going to see states silently make these marketplace facilitation laws a bit more broad.
Oh, that's a nice segue into the next section.
So yes, perhaps the largest thorn in my side in calendar year 2022 was the Colorado retail delivery fee. And I think for most businesses, not just marketplace facilitators, anyone who is selling into Colorado had to deal with the uncomfortable reality that was the introduction of a retail delivery fee. We saw this introduced effective July 1st, 2022. And this was a doozy because I think everybody was scrambling to understand how this imposition affected them, how systemically they could even invoice their customers for the separate line item, whether they had sufficient budget to pay it out of pocket and not collect it from their customers. I know that at my previous company, as a large marketplace facilitator, we were getting hundreds, if not thousands, of calls from Colorado-based sellers relative to our marketplace facilitation and saying, hey, if you marketplace seller do not collect this tax, or you marketplace facilitator do not collect this tax, are we, the marketplace sellers located in Colorado or outside of Colorado who meet certain thresholds, are we required to collect it? And we had to reassure them that even though they could not see us actively collecting it on our site because we were like so many others who were unable to get that mechanism switched fast enough, that we were the responsible party. But I think the challenge with retail delivery fee is the fact that even though this legislation was introduced by Minnesota a while back, they had a TBD kind of approach in terms of the application and the requirements. Now, Minnesota has just updated their guidance on their own retail delivery fee that goes into effect on July 1st of 2024. They updated their guidance on February 21st, 24. So if you haven't been out to Minnesota, take a look at their guidance. They have actually published the exact language that they would like to see on invoices, and that it should be called a road improvement and road delivery fee. The complicating part about Minnesota is that it is a higher retail delivery fee. It's a 50-cent fee on retail deliveries of orders totaling $100 or more. It will apply to clothing, even though clothing isn't taxable in Minnesota. And there will be certain thresholds relative to if you are a retailer or a marketplace facilitator in Minnesota. I think this was the most important development that happened in Colorado, was that they did have a threshold for small businesses to not have to collect this tax. But I think Colorado is interesting because this tax is changing. It's going up, right? And we would probably expect that it will continue to increase. I don't want to belabor this, but it's challenging to comply with, right? These two retail delivery fees are different. There's similar aspects to them, but I can tell you from my own personal experience, it was really difficult to comply with Colorado. And I know that companies struggle because, I think systemically you have internal requirements relative to invoicing and linking to your various tax engines and your own internal engineering and product requirements that make this really challenging. I think what's important also to note is the Minnesota retail delivery fee will be on the sales and use tax return, whereas the Colorado is on a separate return. It's complexity and ambiguity. And I think that unfortunately, we probably will very likely see this be introduced in other jurisdictions in the future.
And
but it's something for everyone to be aware of.
Vanessa, to your point, I want to kind of chime in. When I was in industry, as you said, change your billing systems. Well, for that, we had about 10 of them. And, you know, is it a sales tax? Oh, wait, I need another general ledger account to hold this liability. And I'm going to push it through my tax engine for calculation, but I need to separate it out of my gross sales when I'm calculating my marketplace facilitator activity. And the list goes on. And last time I checked, when the tax department went to IT to ask for a change, we had to get behind sales, we had to get behind marketing, we had to get behind legal. So it takes a huge amount of time to get a system change in of this magnitude. And like you say, I mean, we're going to configure it for Colorado because that's our immediate deadline. And then we're going to have to modify that for Minnesota. And, you know, these are the first two. But I think what we're seeing, in a weird way, we've talked about two increases in taxes that we could call the children of COVID, because everybody stayed at home. And what did they do? They bought things digitally. What else did they do? They ordered dinner. Oh, well, there's two activities we can tax, because everybody's still watching movies and ordering dinner and breakfast and lunch. So they want to get a piece of that. Those are services. So again, are we going after unique targeted services, the low-hanging fruit where we can get the most revenue? Or are we just beginning to see a trend where more states are going to be taxing services? Because they probably need to tax services to meet their budgetary needs, but it's just not a popular thing to have to push through the legislature.
Yeah,
Hello?
oh, go ahead, Courtney.
Well, I was going to ask, I saw a couple of questions in chat regarding to if that in Minnesota specifically, if that fee was applicable only on taxable sales over $100 or if it's all sales over $100. Is there any clarification on that?
There is a very robust guidance on what it applies to and what it doesn't. And so I cannot make sweeping generalizations and say it's only on taxable items because they're taxing it on clothing. They do have guidance about certain items like medicines, over-the-counter medicines, baby formula. So again, I would encourage everyone to go out to the Minnesota site and take a look at the specific guidance, because they do have some carve-outs for deliveries of exempt goods. I think, again, this is going to be challenging if you have a bundled cart, right, in your order, and there are taxable and non-taxable components. This is going to be one of the unintended consequences for companies to implement this delivery fee. Similar to Colorado, if you refund an entire order, I believe that this fee still applies and you won't get it refunded back. I think, you know, I don't want to steer anyone in the wrong direction, because if I was still in-house in my previous marketplace facilitator role, I know that I would be struggling to convey the requirements to my product and engineering teams on this, because there are a lot of layers of complexity about what it applies to and what it doesn't. I think overwhelmingly, if you have a bundled transaction, it's going to be hard for someone to not collect the tax, right? If the taxable components are greater than the non-taxable components, especially if you have such items as clothing and maybe, you know, other items that are deemed to be essential. So it's a great question. I don't want to steer anyone in the wrong direction. I want to point everyone to the Minnesota site. But I think in the face, as I understand it, of dwindling tax departments with limited resources, this is going to be a big hurdle for companies to reach by July 1st.
And I'll confirm, we run into departments of revenue just talking in the hallway that have a 25% staffing shortage. That's horrible to try and conduct your business in such a hectic environment. But another trend we see is states are more willing to collaborate with private industry and bring on partners for resolution of some of these issues where previously you couldn't get their attention. But what they found is you know, your top IT people want top dollar, and last time I checked, it was private industry. So for consulting firms, it's good to collaborate because everyone has ownership and input. I think maybe we're seeing, you know, we had a wave of Wayfair. Well, maybe we're seeing the digital tax wave that's going to hit us for the next 5 years. And then you have people like Nebraska who just want to put in a consumption tax and get rid of all their other taxes. And there's a similar trend going on in Louisiana with the new director of the Department of Revenue wants to eliminate the income tax and supplement it with a more robust sales tax base.
Well, I think that leads us in perfectly into our last slide here, which is talking about some changes with taxability of services. And Nebraska is one of those. So, Brian, I'll pass it over to you.
You should really go read these two bills. You know, you parts of them make a lot of sense. We talk about how departments of revenue don't change with the times. And then they jump on the bandwagon and decide we're going to change with the times and we're going to start taxing what everybody's doing, and that's digital. And now we complain. You know, we got to find that medium. We got to find that mix. And you know, some people complain about New Mexico, but if you've administered their tax, it's pretty straightforward. So I think we're going to see a trend. I mean, I think that the Department of Revenues across the country, you know, Treasury departments, comptrollers, they are in a sprint to generate money quickly. And so they're going to do what they have to. And they're going after some good sources of revenue. Hopefully, 4 or 5 years from now, it'll be a little bit more level as far as let's not target specific things, but have good tax policy that applies across all similarly situated, I know that's a dangerous phrase, similarly situated industries to generate revenue. Any thoughts, Vanessa?
Well, I would encourage reading both of these bills if you are having trouble with your sleep. I don't know if it's on anybody's radar, but I do think one of the things that you highlighted, Brian, that I think is so important for everyone on this call is I think that we got used to being behind our screens during the pandemic, and I know many of us have been heads down with year end, but I think Q2 is a good time to get out there and network with your peers in this space. So Brian does it on a regular basis when he is attending these meetings of legislatures. But I can tell you that when I was in industry, one of the most powerful conversations that I had with my peer group was discussing what are you doing with Colorado retail delivery? What are you doing with digital services taxes, right? When digital services taxes came out in Europe and Maryland bill was introduced, a lot of my peers were having to do projections on, okay, well, what if a dozen states pass something similar? What is that going to look like, right? Whenever there's a change in administration, our CFOs and CEOs and our heads of tax are asking, what is our tax footprint going to look like, right? And so I think the really powerful update for Q2 is to get back into your community in real life, right? Your tax community. And don't be afraid to rub elbows and have conversations about some of these difficult topics because we are all struggling with them, right? Yes, talk to your tax advisors, but also talk to your peers in this space because some really powerful solutioning can come across when you have those conversations.
I concur. Don't be afraid to call your tax policy group within your state. as weird as it is, they love to get calls from taxpayers because it doesn't happen that often. And if you call them, they're typically going to talk to you and respond to you. It's very helpful. And those are the type of connections that you want to have. And don't be afraid to call them, because you're a master of your industry and they have to cover the whole market. And so you can educate them, they can educate you, and now you have a contact at the department. And that contact who gave you clarification is also a great resource to say, I'm having problems with my payments going through. Who's the best person to talk to in the department? They want their money. They're going to point you to the right person. So I agree, man. That's a great idea.
Yeah, I think anecdotally, the other trend we're seeing is the silver tsunami, right? So, I'm not silver because I employ a hairdresser regularly, but I think we are seeing at the state level a high number of turnover due to retirement post-pandemic. And there is a knowledge gap and a brain drain. And yes, it is not just you. Your audits are getting more difficult. They are asking for more things. So keep that in mind. We are all struggling through, right? And I think I want to acknowledge that not all companies have a government affairs team. That's a pretty valuable individual to have. But I think it is important at a high level to kind of have a pulse on what is developing, especially in your home state where you're headquartered, where you may have some influence due to your payroll and your property in the state. But I think that I want to acknowledge, because this is Q2 Outlook, that it is a challenging time right now in indirect tax.
And along with expanding the tax base, departments are getting much more technical on the way they conduct audits. I sat through a meeting a few weeks ago with the state of Arizona, and they're putting something in place that's going to map your tax rate to your tax license and ensure that the tax rate you're remitting ties to the location where you pulled your license. Because in Arizona, you need a license for every location. Pretty much every location has a different rate. And what they've noticed is a trend of people pulling a license in the lowest taxing jurisdiction and then selling all over the place. And so AI is great, and the departments are jumping on the bandwagon. And even if it's just more smart analytics, they're finally seeing the value in that. So expand the base, be more thorough in your audits. That's how states get more revenue.
Yeah. Well, that was a perfect segue. One of my first questions that I was going to ask about in our Q&A segment was about what you guys were seeing with audits and if there were any changes there. So I appreciate you answering that already. Vanessa or Dorothy, is there anything that you would want to share around audits or any trends that we're seeing in 2024 along those lines?
Well, we recently learned that the California CDTFA is one of the 3 state agencies that is implementing and conducting a pilot of Gen AI and machine learning. And I think anecdotally, what this means for small to medium-sized businesses is, in not just California, but in other states, if you register for payroll taxes, you may get a notice to file for sales and use tax when you didn't before. We're getting that question actively from some of our clients as they register employees for payroll taxes. They're saying, hey, we got this notice to file excise and use taxes in Washington. We don't think that our offerings are subject to the tax. Why are we seeing this? And so I think that, to Brian's point, this is the kind of technology implementation I think we all expected to see prior to the pandemic, and it didn't necessarily happen. And then as tax departments became flush with cash during the pandemic, they have implemented some of these technology improvements and enhancements. And so I think that there are more notices going out faster to taxpayers. I think that we are seeing refund claims are being treated as audits, especially in jurisdictions that tend to be a little bit more tax deficit. And I think that we're seeing a reluctance from newer auditors to really understand the issues, and that they're pushing everything up to their supervisors who are more experienced and who've been around for longer. So I think it's a challenging audit environment, is what I would say.
Okay, great. Thank you. We have just a couple of minutes left. I am seeing quite a few questions that are very specific to the individual's business or their industry. Like I mentioned at the beginning, we're not able to go into specifics on that because we can't provide tax advice. But one broad question that I am seeing, we focused a lot on individual states and what we're seeing with proposals and kind of trends in that way. What about on the international space? I think on the last 2024 tax changes webinar, we talked a little bit about the sweeping e-invoicing mandates that are kind of taking the world at large. And then we also talked a little about the VAT in the digital age and the postponement of that. But are there any other bigger trends that we're seeing in the international tax compliance space that are worthy of a call out?
I think we're going to be required, and this goes way back to, I don't know, how long ago did Brazil start asking for, well, they're going to want more detailed transaction data on a daily basis. In Brazil, the issue was that you had to push your invoice to the state to have them assign an invoice number. They've already done their audit at that point, and they've kind of approved your invoice at the same time, but they have all your data. And so it's intrusive. I think Europe, as funny as this sounds, our mindset is that we're, leading the trend. But in some of these technology spaces related to tax, I think we need to truly focus on what's happening in Europe, because I think they already have a lap on us. And so there's a lot to learn from them. And many large companies have a presence outside the United States, so they're getting some exposure to that as they grow in those European markets, in Asia and places like that. I think we're going to see those trends coming to the US. E-invoicing is going to, I think, hit us upside the head in the next 2 years. I think it's a great concept. I'm not sure medium to smaller companies are ready for that. Big companies have been anticipating it, but that's what I think is happening.
I was just going to say that I think there's a focus on inbound businesses, right? So companies who have, historically been doing business in Europe and not had to be concerned about their US activities. I think that there's more scrutiny here in the US on those. And I think what's going to predate e-invoices, if I'm just saying so, because I think the technology is still woefully behind at the state level, is I think we're going to see more states with prepayment requirements and accelerated payment prepayments, especially those states that are facing budget deficit. That's what I would anticipate, is that there will be more of a prepayment requirement here in the US.
Great. Well, I want to be respectful of everyone's time, so I think we are just over the 1 hour mark, but appreciate all of our attendees. Thank you for spending the last hour with us. I always learn a lot on these webinars, so I hope that you all found it valuable as well. To our speakers, Brian, Dorothy, and Vanessa, thank you so much for spending the last hour with us and really imparting some of your knowledge and your expertise that you've seen in the space. Just a couple of last minute reminders. Like I mentioned at the beginning, we did offer 1 hour of CPE credit for this. So if you are eligible for that and met the requirements, you can download your certificate on the console. You'll also receive an email with the link to download your certificate if you don't have access to it today. And like I said, we did record this presentation, so we will send out that email with the link to this console in the next 24 hours. So if you want to view it again, share it with a colleague, you'll have access to do that. And we are hosting these webinars on a regular basis. So if you're interested in seeing what other webinars Avalara has to offer, you can go to our website at avalara.com/webinars and see what our future topics look like. So thank you again so much, everyone, for being a part of this, and we'll see you for one of our future webinars very soon. Thank you.